the market just blinked, not a cute little dip. A blink that usually happens right before a staircase turns into an elevator. Over the last few weeks, the biggest names on the board didn't fall together. They peeled off one by one, like a roof losing shingles before the whole thing caves in. That's the event. A cluster of major peaks across megacaps, crypto, and even so-called safe trades, followed by stress signals in the plumbing of money itself. And if you're thinking, okay, so markets rotate? Good. Keep that skepticism. Because the scary part isn't the rotation. The scary part is what the bond market is whispering while everyone else is cheering the stock ticker. Here's the first trap most people fall into. They look for one big crash candle, one dramatic day, one headline that tells them, now you may panic. Markets don't work like that. Big tops are usually silent. They look like a party where the DJ is still loud, but the exits are already jammed. So we did something simple and brutal. We lined up the peak dates of the most crowded trades people have been chasing. Megacap tech, consumer darlings, banks, chips, AI hype names, crypto, even the safety assets. Then we asked a cold machine brain a blunt question. Do these peaks mean anything? Not predict the future, not tell us a story. Just this. Are clusters like this a symptom of something bigger? What came back was uncomfortable. One model said, this is a rolling top. Another said, slow down, you're overfitting. So we pulled in a third voice to judge the fight. 3 different minds, the same raw list. One conclusion, the surface looks fine, but the foundation looks tired. A healthy bull market is like a marching band. The drums, the brass, the flags, everything moves forward together. When the band starts breaking formation, you don't notice it at first. One row steps out of sync, then another. The music still plays, but it's no longer a band, it's a crowd. That's what a rolling top means in plain English. Not everything crashes at once. The most stretched, most sensitive, most hyped trades get hit first. The generals wobble. The soldiers keep marching for a while. Then the whole army realizes the map was upside down. In the data, that's exactly the vibe. Early peaks in expensive momentum names. Later peaks in the everyone owns this big tech trades. Late cycle strength in banks and broad indexes. Meanwhile, risk on assets like crypto, hot chips, and broker darlings hit highs and quietly started slipping. So here's the key question. If the rally is so healthy, why are the leaders taking turns collapsing? Because liquidity is not a feeling. Liquidity is oxygen, and when oxygen gets thin, the strongest runners don't sprint harder, they quietly stop. The second trap is thinking prices tell the whole story. Prices are the headline, the plumbing is the story. So we added plumbing. We looked at the yield curve, especially the short end versus the long end. That curve is the bond market's lie detector. We looked at central bank communication. We looked at the effective policy rate. We looked at repo activity, because repo is where the financial system borrows its next breath. When we fed that into the same machine brains, the tone changed from maybe to this could get ugly. Here's the weird part. Many people think an inverted yield curve is the recession signal. It's inverted, therefore crash. But history plays a meaner game. Recessions often show up after the curve starts to steepen again, not because things got better, but because the market starts pricing rate cuts. And cuts usually come when something breaks. So if you want one clean tell, it's this. When short-term yields fall hard while the policy rate is still high, the bond market is basically screaming, you're late. Late isn't a vibe. Late is a hazard. We're not here to short everything like cartoon villains. We're not gambling. We're measuring. This is educational. We manage risk. But we have to be honest. When the short end drops under policy and the curve steepens for the wrong reasons, that's not a victory lap. It's a smoke alarm. At the same time those peak dates were stacking up, repos started acting like a stressed engine. Not exploding yet, but revving in a way that suggests someone needs cash fast. Repo is the overnight pawn shop of the financial world. Banks hand over high-quality collateral to borrow cash. When that pawn shop gets crowded, the system is thirsty. And thirst is invisible until it isn't. One model took an aggressive view. This looks like a liquidity peak. Everything topped. No safety net. Another pushed back. Some of this may be seasonal. Year-end treasury flows, not proof of collapse. Good. That's the disagreement we want. Markets don't pay you for drama. They pay you for being right enough, early enough, with the right size. The judge favored the disciplined model, the one that refuses to leap without evidence, the one that separates signal from story. But the aggressive model still refused to back down. Why? Because you can be correct and still get wrecked by timing. If a building is on fire, you don't wait for the roof to fall before you leave. So what do? We focus on 3 to 5 levers. Not 20, not noise. First, leadership fractures. When leadership rotates from growth to safety, while indexes grind higher, that isn't always bullish. Sometimes it's the crowd grabbing the last sturdy chair before the music stops. Second, the bond market's message. If bonds are pricing cuts while policymakers talk tough, that contradiction matters. If growth is so strong, why is the 2-year yield sliding? Third, funding stress. Repo, liquidity lines, quiet adjustments to emergency backstops. You don't raise the ceiling on emergency facilities because everything is fine. You do it because you don't want the door locked when everyone shows up at once. Fourth, credit. High yield spreads, junk versus risk-free. Credit is the grown-up in the room. Stocks can pretend, credit usually can't. If credit spreads widen while stocks keep partying, the floorboards are creaking. If the market is really topping, it won't show up first in headlines. It shows up in boring places. Funding, credit. Quiet corners nobody wants to watch. That's why this matters. The crowd watches price. Professionals watch plumbing. Now let's address the AI angle. AI isn't a crystal ball. It's a mirror. It reflects the data you feed it and the biases baked into it. When one model screams bearish and another says slow down, the value isn't the prediction. It's the map of risk. And that map says we might be in that moment where the cartoon character has already run off the cliff, but hasn't looked down yet. If that feels familiar, you're not crazy. That's what late cycle feels like. The mistake people make next is going all in bearish or ignoring it completely. Both are emotional. We don't do emotional, we do scalable. Position size is a dial, risk is a dial, exposure is a dial. We turn them without smashing the radio. We trim froth when trades stop acting right. We reduce leverage because leverage turns normal drawdowns into liquidation events. We build triggers instead of predictions. And we keep upside exposure. Because if the disciplined model is right, we don't want to be angry and broke on the sidelines, so watch the curve, watch credit, watch funding stress, watch market breadth, and watch psychology. Because the final stage of tops isn't fear, it's complacency. That's the most expensive sentence in markets. Nothing bad can happen. We don't need certainty. We need preparation. We keep exposure, but we harden the ship. We stop worshipping narratives. We avoid being forced sellers. That's the game. If we're wrong, it will show up in tightening spreads and improving breadth. If we're right, the market won't whisper. It will snap. Stay ready.
Hello my dear friends, welcome back. Today my new video and my Money Made Simple channel. This is my channel, so friend, like this channel and subscribe my channel and press bell icon. So friend, let's start. The market just blanket, not a cute little dip. A blink that annually happens right before a staircase turns into any elevator. Other than last few weeks, the biggest names of the pod didn't fall together. They peeled off one by one like a roof, losing shingles before the whole thing canvas and that's the event. So friend, a cluster of major peaks across max caps, crypto, and even so-called safe traders followed. Safe traders followed, and friend, I will be explain called safe traders followed by stress singles and the plumbing of money Tesla. And if you thinking, okay, so markets rates rotate, good, keep that speculation, because the scary part isn't the rotation, the scary part is what the rotate, the scary part is what the bond market is developing well. Everyone else is the cheering the stock taker here the first